I'm Corinne Ferguson, an accounting teacher at St. Mary's College. Now at this time when online classes have become a necessity, my HOD, Mrs. Gomes, and another accounting teacher, Miss Lala, have started putting together some online material in the form of PowerPoints and videos. The topic of our first lesson is probably the most challenging of the accounting cycle, adjusting entries. Why do we have to record it? In fact, what is it? These are some of the things that we are going to address in this video as we introduce you to the first adjusting entry, accruals and prepayments. So our topic for today is adjusting entries, and more specifically accruals and prepayments, and this is the introductory lesson. So this is tested in final accounts. In the syllabus you will find it under section 6, why adjustments are made to financial statements at the end of the period. This is basically our topic for today. So are you ready to begin? Good. So you would remember that we have our 5 steps in the accounting cycle, 6 if you count in the source documents. We have the source documents and we will journalize, post the ledgers, which would be our T accounts, do the trial balance, which was the list of debit and credit balances. And usually we would have to go to the 4th step, which is the adjusting and closing entries. However, we skipped that and we went to the final accounts, the income statement and the balance sheet. So basically when we did the trial balance, it was what we call an unadjusted trial balance because we had not taken into account the adjusting entries. So the final accounts that you would have learned how to prepare are actually final accounts without the adjustments. So this lesson is about going now and learning the adjusting entries. And what are they? Basically, adjusting entries are entries made at the end of an accounting period to allocate revenue and expenses to the period in which they belong. So at the end of the accounting period, we do what is called adjusting entries. Once again, the emphasis is that it is made at the end of the accounting period before the final accounts are prepared. So looking at our accounting cycle, you would see that we use the source documents, we journalize, and we post the ledgers. For each transaction, you will enter that transaction into a journal and then you would post to the T accounts. That is for each transaction. However, with the trial balance, that is done at a specific point in time where you list all your debits and your credits and it's supposed to balance. That is how the adjusting entry is that we do not do it for each transaction like the journals and the posting to ledgers. We do it at the end of the period and right before we go into the final accounts. So why are adjustments made at the end of the period? Okay, so we know that the income statement, which is used to calculate profit, that is prepared for a specific period, and that is usually done at the end of the period. Therefore, if it is that we use revenue and expenses to calculate net profit in the income statement, then it would logically be that those revenue and expenses used must also belong to the same period that you are calculating the profit for. Okay, so you may be a little bit confused still. So I found this on the net when I was looking up some things. It's accrual world. Do you get it? Accrual world. Well, that is basically going to be the motto, that accrual is the principle that states that when you are calculating net profit in the income statement, it is the expenses incurred even if the business did not pay as yet, and the revenue earned even if the business has not received the money as yet. So there are basically 2 bases. There's the cash basis where we would have recorded when we pay our expenses and when we receive our revenue. But that is not how we do it in accounting. Hence, it's an accrual world. Basically, under the matching principle, we have to record the expenses incurred and the revenue earned rather than the expenses paid and the revenue received. So because of that, we have 4 types of accruals and prepayments: accrued expenses, accrued revenue, prepaid expenses, prepaid revenue. So there are 2 accruals, which would be accrued expense, accrued revenue, and 2 prepayments, prepaid expense and prepaid revenue. We will go a little bit more into what they are, but let's just take a little a better look. And we are going to start first with the expenses. If you remember, expenses are the cost of using your assets. So in order to use your car, you have to have gas, you have to pay insurance. In order to be able to use your building to work or live in, you have to pay your utilities like your water bill and your electricity bill. You may have to pay rent because you may not own the building, so you will have to pay rent on that. Salaries is an important expense because the workers, they help you to generate income, and the business will pay the workers. So salaries are always an expense. We don't receive salaries. And then of course there's the interest on loan. Whenever you take a loan, besides having to repay that loan at the end of the period, you have to pay interest on that loan for having used that money. So these are your expenses that are very necessary in terms of running your business. So the expenses that are used to calculate the net profit must belong to the same period, which is what we were stating before. Therefore, the expense amount entered in the income statement is the amount incurred for the same period. So there's that word again, incurred, and that is what is going to keep on coming up. So what are expenses incurred? Incur means to become liable to pay, and it is usually because of your actions. So the expenses are the cost incurred in doing business to generate revenue. You must pay these expenses in order to use your assets, especially to generate your revenue. So expenses are incurred whenever a resource is used. So whenever you use your asset, like for example your car, you would incur a gas bill. Whenever you use your buildings, your classrooms, any room, you would incur electricity bill. Whenever you use your computers, whatever asset you use that needs the electricity, you are incurring an electricity expense. So expense incurred versus expenses paid. Just in case, we are emphasizing incurred and paid do not mean the same thing. So expense incurred and expense paid have 2 different meanings, and because of this, the expense incurred may be more or less than the expense paid. So basically, when you're incurring your expense, you are supposed to pay it, but when you do pay it, it may not be the same amount as the amount that was incurred. You may actually pay more than was incurred or less than was incurred. So for example, looking at this electricity bill, the electricity expense is incurred because of usage, using an asset. Like your computers, the room, the televisions, anything that uses electricity. So because of the usage, you incur an expense. In this case, the expense incurred is $159.16. Now, when you get your bill, have you paid it as yet? You cannot pay it until you get your bill. So which means that this is incurred, but it still has not been paid as yet. So once again, the bill shows how much was incurred, which is $159.16 for the period because of usage. but it has not been paid as yet. So because the amount incurred is not always the same as the amount paid, if you have paid less than incurred, then you have what is called an accrued expense. So just repeating that, if you pay less than the amount that was incurred, you have an adjustment called an accrued expense. If, however, you pay more than the expense incurred, this is called a prepaid expense. So accrued expense is when you pay less, and prepaid expense is when you pay more. So this brings us to the definitions of two of our adjusting entries. Remember, we have four of them: accrued expenses, accrued revenue, prepaid expenses, prepaid revenue. But since we are dealing with expenses, our first one is accrued expense. And accrued expenses are expenses incurred in the period but not yet paid by the end of the period. In other words, you are still owing money. So once again, whenever you pay less, it means that you are owing money, and that is called an accrual. So let's take a look at our bill again. Once again, how much was incurred? $159.16. In our example, let us assume that when we pay the bill, we pay $100. Now that means that we have paid less than the amount incurred. So if you pay less, that means it's an accrual. And how much less did we pay? $59.16, which means that our accrued expense, which is still owing, is $59.16. Okay, so it's accrual world. Let's be practical. Rent owing of $500 is known as, very simply, it's not a prepayment, it's an accrual. If rent incurred is $1,200 for the year and the amount paid is $1,000, what is the accrued rent? So because the amount paid is less, that means it's an accrual. How much less is it? $200. So the accrued rent is $200. If rent incurred is $1,200 for the year and the amount paid is $1,000 by the end of the year, what is the rent entered in the income statement? So it's the same information as the one before. However, they are asking for something different now. Before they asked what is the adjustment in terms of the accrual. Now they're asking what is entered into the income statement. Remember, always the emphasis is for the income statement, you always put the expense incurred. So how much rent was incurred for the year? $1,200. So the amount to be entered in the income statement, $1,200. If a business rents a building for $200 per month but has only paid $2,000 by the end of the year, what is the rent in the income statement for the year? So that's a lot of words and numbers. Well, there are two numbers there. What you have to look specifically at is what are they asking for. They're asking what is the amount for the income statement. And the emphasis, once again, it is the amount incurred. So if the amount incurred per month is $200, then for the year it will be 200 multiplied by 12, which is $2,400. So the amount to be entered in the income statement, which is the amount incurred for the year, is supposed to be $2,400. So $2,400 entered in the income statement because that is how much was incurred. So same information again, but they're asking for something different this time. This time they're asking what is the accrued amount. So we had worked out that the incurred amount was 200 by 12, which is $2,400. Because the incurred amount was 200 by 12 months, which is $2,400 or $2,400, and he only paid $2,000, which is less, that means there is still an amount owing or an accrual of the difference, which would be $400. So the accrued amount is $400 because he paid $400 less than the amount that was incurred for the year. So we just did the accrual. We are now going to move on to the second adjusting entry or the type, which is the prepaid expenses. Prepaid expenses are expenses paid in the period but not yet incurred. In other words, prepayments are when the amount paid is more than the amount incurred. Another way of saying it is that we have paid in advance. Whenever we pay more than incurred, we have paid in advance or we have made a prepayment. So let's look at our bill again. Once again, the incurred amount is $159.16. Let us assume in this example that we paid $200, which means that in this case we paid more than the amount incurred. So there's a prepaid amount. And the prepaid amount, how much more did we pay? $40.84. So our prepayment or the amount we paid in advance is $40.84. So let's get into some questions again. Holmes Guest House pays electricity of $6,000 for the year. Once again, that is the amount incurred. That is how much they pay for the year, or they're supposed to pay for the year because they have used up that amount of electricity for the year. However, at the end of the year, they paid $6,500. Which means that they paid more than the amount that was incurred or the amount that they were supposed to pay, the amount that they used up. So that means that this is a prepayment or prepaid expense. So if a business rents a building for $2,400 but has paid $3,000 by the end of the year, what is the prepayment? Because it is a prepayment, once again, they paid more than the amount incurred. How much more did they pay? $3,000 minus the $2,400 will give you $600. So there should be a prepayment of $600. If a business rents a building for $200 per month, but has paid $4,000 by the end of the year, what is the adjusting entry? So to find out that, we will have to work out the amount incurred. So if the amount incurred for the month is $200, then for the year it will be $200 multiplied by 12, which would give you $2,400. If the amount incurred is $2,400 for the year, but they paid $4,000, that means they paid more, so it would be a prepaid expense. So you see that there are three options with prepaid expense. We take out option C because it is not an accrued expense, it's a prepaid expense. To find out how much the prepayment is, how much more did we pay? That would be $4,000, take away the $2,400, which is $1,600. So you have a prepayment of $1,600. If a business rents a building for $200 per month but has paid $4,000 by the end of the year, what is the rent in the income statement for the year? If you've noticed, it's the same information as the question before, but they're asking for something different. They're not asking for the adjusting entry, they're asking for what goes into the income statement. So the emphasis is that what is entered in the income statement is the expense incurred. And if the expense incurred was $200 per month, then for the year it will be 200 by 12, so that's 2400 is the amount that is entered in the income statement. So we have just dealt with the expenses, so we are going to go on to the revenue. We had accrued expenses and prepaid expenses. Revenue, or as it is known in Alice as income, is the amounts that is earned during the accounting period from the operating or the operations of the business. Simply, they are what the business earns for providing goods and services. Now, our main source of income or revenue would be when we sell stock. Whether we sell it for cash, for check, or on credit, it is revenue that is earned. So in the case of when we sell on credit, even though we have not received the money as yet, we have earned that money. So that will all be revenue that is earned. Other examples of sources of revenue would be commissions received, dividends received, interest received, rent received, discount received. So the common word there is received. That's how you would know that it is revenue. So according to the accrual or the matching concept, the revenues used to calculate net profit must belong to the same period. Therefore, the amount entered in the income statement is the amount earned for the same period, which is usually 1 year. So we have our third adjustment, our first revenue. Accrued revenue are revenues earned in a period but not yet received by the end of the period. In other words, it is money that is owed to the business because we have earned it already, we just have not received it by the end of the period. So accruals are when the amount received is less than the amount earned. So just like with the accrued expenses, the accrual was when it was less than the expense incurred. For revenue, the accrual is when the amount received is less than the amount earned by the end of the period. So what we have here is a contract, the installation of certain fixtures, and the amount that is earned according to our nice little invoice there is $2,844.80. Now we do not know if anything has been paid as yet. What we do know from this is that this is the amount that is earned, and this would be the amount that would be entered into the income statement as revenue. So in our example here, we are going to assume that the amount that we did receive was $2,000. If the amount earned was $2,844.80 and we only received $2,000, that means we received less than the amount earned, so we have an accrual. And how much less did we receive? $844.80, which means it's still owing or still accrued. Prepaid revenue would be revenue received in a period but not yet earned by the end of the period. So we also call it unearned revenue. You have received money but you have not earned it as yet. So prepaid revenues are when the amount received is more than the amount earned. So accruals, once again, would be less than. Prepayments would be more than the amount earned. So once again, how much was earned for the period? It was $2,844.80. However, we are going to assume that we received already $3,000. $3,000 is more than the amount that we actually earned. That means that we have a prepayment or unearned revenue of $155.20. To be remembered. So these are the important things that you have to remember. First one is the accrual or the matching principle. Just remember, accounting is accrual world. So to match expenses and revenues for a time period to calculate the correct profit or loss for that period is the purpose of the accrual or the matching principle. In other words, it states that you must match the expenses and revenues for the period with that particular period to get the correct profit or loss. And the correct expenses would be the expenses incurred, and the correct revenue would be the revenue earned. So once again, there are our 4 types: accrued expenses. And we learned that the accrued expense or expense owing would be expenses incurred but not yet paid. In other words, the amount paid is less than the amount incurred. Then we have accrued revenue, where the revenue received is less than the revenue earned. So therefore, it is revenue earned but not yet received. Third one would be prepaid expenses, and this is in no particular order. Expenses paid in advance but not yet incurred. That means that we paid more than the amount of the expense that is incurred. And the last one, prepaid revenue, where revenue is received in advance, not yet earned. And another name for that would be unearned revenue, because we have not earned it as yet, even though we have received the money. So just remember, 2 accruals: accrued expense and accrued revenue, 2 prepayments: prepaid expense and prepaid revenue. So this is just a very easy way. How do you identify which type of accrual or prepayment? Of the 4, for the expenses, you are comparing the amount paid with the amount incurred. And for the revenue, you are comparing the amount received with the amount earned. So you always look for those 2 figures: amount paid or received and amount incurred or earned. And the accrual will be if the amount paid or received is less than the amount incurred or earned. And the prepayment will always be if the amount paid or received is more than the amount incurred or earned. So we have a nice little activity, St. Mary's, in terms of your workbook. Here you will have to identify the types. Once again, what are the 4 types? Prepaid expenses, prepaid revenue, accrued expenses, accrued revenue. So you have 4 types, and you have to identify which of the types per transaction. And once again, how would you do that? Always look for or identify the incurred or earned and the paid or received. And of course, you will also have to identify which one is the expense and which one is the revenue. So always remember that too. In fact, that's the first thing you're going to do, whether it's an expense or whether it's revenue. And then you're going to try and identify whether it's prepaid or whether it is accrued. And that's it for our introduction for the accruals and prepayments. In our next lesson, we will go into like journals, and then the lesson after that, we will do the T accounts. And finally, we will be preparing the income statement. Just remember, once again, the income statement, you will always put the expenses that are incurred and the revenue that is earned.
again.
Just keep on going, right?
Go on.
Cool. Good.